Yo, what's going on, guys? My name is Vince and welcome back to the channel. Now, if this is your first time here, I make educational content on stock trading, options trading, as well as investing for your future. So if you guys are interested in some of those topics and want to learn a little bit more about the stock market, then go ahead and consider subscribing to the channel. Now, first off, I want to say thank you to everyone that has subscribed to the channel so far. We just passed over 2,000 subs, so I'm really happy to know that some of the content that I'm pumping out is helping some of you out there. So in last week's video, we went ahead and we covered the option strategy called credit spreads. Now, if you haven't watched that yet, I'll put a link in the description below and I'll also pop it up on the screen right here. Now, after watching that video, some of you guys had questions about a similar strategy called debit spreads. So in today's video, guys, we're gonna go over just that. We're gonna dive into the charts, show you guys how to enter these trades, how to profit off them, and some of the risks that you need to be aware of when you're in them. Now, before I roll the intro, I wanna get you guys' thoughts on the color scheme in the studio right now. I got the blue on the desk and the purple in the new LifeX bulb back there, throwing some money back into the studio to make sure that you guys are enjoying the videos. So let me know what you guys think in the comments down below, and also make sure to smash that like button. All right, guys, so I got the charts pulled up here, but before we dive into it, I wanna go over the main difference between a credit spread and a debit spread. So on a credit spread, you're going to be receiving money into your account, hence the credit. And on a debit spread, you're going to be paying out money to make that trade. Similar to when you buy a put or when you buy a call. Now, the difference between just buying a put and buying a call and a debit spread is that there's a second leg to the strategy, which entails you selling the contract one strike price above the one that you buy. Now, I know this is a little difficult to comprehend, just me talking to you about it, so let's go ahead and visualize it here on the charts. Got it pulled up, let's go ahead and dive right into this. Let's make ourselves a scenario and go over one of these trades. So on the left side here, I have the options chain for Amazon. This is the E-Trade Pro platform. And on the right side here, I just have Thinkorswim. I have the Amazon chart pulled up. I have a 10-day, 1-hour chart. So let's say that we think that there will be market support and Amazon will continue to rise, with the recent bullishness in the market. So let's say we think that Amazon could reach, all-time highs, 2460 by next week. So what would you do in that situation? Usually you would just buy a call, right? So if you wanted to buy the 2460 strike on an April 24th expiration, that would cost you $4,500. Now, for most traders, small traders, or even medium-sized and large traders, taking a $4,500 trade, having the risk of losing all of that, is something that most people don't want to risk. So most people, what they'll do is they'll go, smaller traders will go super far out of the money and look for options that they can afford. So maybe around here they want to spend $400 or like $500. Now, the problem with that is that your IV continues to increase and any move against you will really crush that contract. So instead of doing that, you can use a debit spread to make these contracts, basically making these contracts cheaper. So first leg of the debit spread is to buy a call if you think the stock will go up. So let's buy that 2460. Now, what happens now? So we can see that if you were to buy one, you would be spending $4,265. Now, if we look at the snapshot, we can see that your max loss is that, the full price of the premium. You have a 67% chance that you'll lose it all. So, not good probabilities for you, but your max profit is infinite, right? So that's great about the call. But personally, I wouldn't take this trade because I'm not gonna go ahead and risk $4,200 to say that Amazon will continue higher. Now, what can I do to make this price a little bit cheaper? I still want Amazon to go higher. How can I make this contract cheaper? It's something that I can afford. So what I can do is I'll buy that 2460, but what I'll do is I'll sell the 2470. So one strike price higher, and I'll actually sell that one. So if I press on the 3770, I'm selling the 2470 strike and I'm buying the 2460. Now the amount that I'll spend is if I buy one contract is now $237. Now, why is that? Now, the reason for that is because you're going to be buying the 2460, meaning you're going to be paying that out, and then you'll be receiving a credit for the one that you sell, and the difference is what you pay for. So now when we look at the snapshot analysis, we can see that our max profit is capped now, whereas before it was infinite, and your max loss is also capped, which is what you paid for. The amount that you paid for the contract is now your max loss. So now we can see the probability is still the same, right? It's still, probability is against you. That's always against you when you're buying a naked put or buying a naked call. It's still against you in this situation. But the nice thing is that you paid much less for this contract. You have a max loss of $237, which is something that's a little bit more comfortable for most traders. And you have a max profit with a 1 to 3.22 risk to reward ratio. So yes, downfall is that you're capping your profits, but who wouldn't be happy with a $763 gain on an Amazon call option? Now with any option strategy, there's gonna be pros and there's going to be cons. So the first pro that I see when using a debit spread strategy is that you're going to be able to afford much more quality contracts on some names like Amazon and Tesla that usually have some crazy high premiums for much cheaper of a price. So instead of having to go all the way down in the options chain, going really far out of the money, you can go ahead and use the debit spread to limit the amount that you have to pay. Now the second one is that you're going to be capping your losses at a much lower amount than you would be if you were just buying the call or buying the put. Now the con that I see when using this strategy is that you are implementing a max gain. So no matter where the stock goes, you could be totally right. It could go to 3,000, 4,000 on Amazon, but no matter what, you're always gonna be stuck at that max gain. All right guys, so we went over the call side of the debit spread, but we can also use this strategy on the put side if we think the stock is going to decline. So if we use this same example on Amazon, instead of saying the stock's going to go up, let's say that it'll find some support or retrace down to this 2320 area. So what would you do if the stock is gonna go down? You would buy a put. So let's start with that. So buying the put, the 2320, that would be right here. So as you can see, if you bought one contract, you'd be risking $4,600 on this trade. That's your max loss. That's how much you'd be potentially losing on buying a put here. Now, for most people, that's too much to risk, or they just don't have enough buying power. So what's the next leg of the debit spread to make this a little bit more affordable? And that would be that you would sell the put that's one strike price above it here at 23.15. So we went ahead and we sold this put, meaning you'd be receiving that premium. You can see that we are now only spending $122 on this put trade. So we still want the stock to go down, but instead of just having, a naked put here, we are now covered by selling this 23.15. So we look at the snapshot analysis, we can see that our max potential profit here is $378, and our max potential loss is now $122. Now you can see the probability is still against us, so it's 60% that will hit our loss and 40% that will hit our gain. But our risk to reward is great in this situation. It's about a 3 to 1 on this trade. So as you guys can see, this debit spread strategy just makes these trades a little bit more viable for some smaller traders that want to have a good risk to reward and want to still trade some larger companies like Amazon that have these crazy high premium prices. All right guys, so there you have it. We went over the debit spreads on the call side as well as on the put side. If you guys have any further questions, make sure to let me know down in the comments below. If you want to join me on StockTwits, I have an options trading room that has a little bit over 300 members. We have daily discussions in there about recent events, recent stock moves, some really active members and some really nice guys in there that help out new traders. So feel free to add me on there and join the room. The link is down in the description. Also, I have my Instagram down in the description. Add me on there, DM me on there any of your questions, and I'll definitely respond. So guys, I hope you enjoyed the video. If you did, make sure to smash that like button. It'll really help out the video and help out the channel. We've been growing nicely lately, and I'm really happy to see the progression that we've had. Also, make sure to subscribe to the channel if you want to stay tuned for some future videos. So guys, have a great weekend. Stay safe out there, and I hope to see you in the next one. Peace.